Hay anchas temporales en circuito en Portugal. En realidad. Your video is on.
எல்லாருக்கும் வணக்கம். We're just waiting for a few more people to join in, maybe a few more minutes. Just please bear with us for a few more minutes.
Hello. Okay. ஆஹ் எல்லாருக்கும் வணக்கம். இது வந்து ஐபிசிஎன் 2017 அந்த ஈவெண்ட்டை முன்னிட்டு we are doing a series of webinars. போன வந்து அண்ணா சுந்தரம் அவங்க வந்து இமோஷனல் இன்டெலிஜென்ஸ் ஃபார் ஆண்டர்பிரினர் சக்சஸ்ன்ற இதுல வந்து ஒரு வெபினார் கண்டக்ட் பண்ணியிருந்தாங்க. அதை தொடர்ந்து ஒரு ஃபினான்ஸ் ரிலேட்டட் டாபிக் எடுத்து வெபினார் பண்ணுவோம்னு யோசிச்சுட்டு 2 பார்ட்டா ஸ்பிளிட் பண்ணியிருக்கோம். ஒன்று வெல்த் மேனேஜ்மெண்ட் ஃபார் ஆண்டர்பிரினர்ஸ், இன்னொன்று வந்து இட்ஸ் குவைட் அ நியூ டாபிக், கிரெடிட் இன்சூரன்ஸ் ஃபார் டீரிஸ்கிங் ட்ரேட். ஸோ இந்த 2 டாபிக்ல குமார் முத்தையா அவங்க வந்து நெக்ஸ்ட் ஒரு 1 hour ஒரு 45 minutes இந்த 2 டாபிக்லையும் பேசுவாங்க. Last 15 minutes, let's have question and answers on this. Over to Kumar Muthaya.
எல்லாருக்கும் வணக்கம். முதல்ல ஒரு கிளாரிபிகேஷன், ஒன் ஆஃப் த டெலிகேட் கேட்டிருந்தாங்க நேற்றுக்கு, இந்த 2 டாபிக்கும் என்ன லிங்கேஜ் அப்படின்னு சொல்லி. எந்த லிங்கேஜும் கிடையாது. இட் இஸ் ஜஸ்ட் தட் வி வாண்டட் டு கவர் 2 டாபிக்ஸ். ஸோ டாபிக் 1 இஸ் வெல்த் மேனேஜ்மெண்ட் ஃபார் என்டர்பிரினர்ஸ். டாபிக் 2 இஸ் credit insurance for de-risking trade. So we are taking on wealth management first for entrepreneurs. ஸோ என்னை பற்றி ஒரு சின்ன இன்ட்ரொடக்ஷன். இங்கே ஊர் காரைக்குடி, மாத்தூர் மணலூர், கெமிஸ்ட்ரி பிஎஸ்சி கெமிஸ்ட்ரி காரைக்குடி அழகப்பா காலேஜில் படித்தேன் 1983. அதுக்கப்புறம் இந்தியன் பேங்க் எக்ஸாம் சிஐஐபி, அப்புறம் சிஎஃப்ஏ ஃப்ரம் சார்லோட்ஸ்வில். ஃபேமிலி ஒய்ஃப் மீனா குமார், சிறுவயர் ஹவுஸ் ஒய்ஃப். டாக்டர் வந்து அஷ்மிதா. She's doing an undergraduation in London. And my passion is playing bridge and teaching. So I basically know only 2 things, money and banking. And that's where I am. So we have a few questions. 6 questions are there. So now the organizers would be sending out the questions for a poll. I just need your quick feedback on those 6 questions to enable me to understand your risk appetite is slightly better. So the questions now will be short by the organizer. You have a minute to answer all those 6 questions. The questions will be coming one after another. Please answer them. Thank you.
சுந்தரம், அந்த கொஸ்டின்ஸ் போஸ்ட் பண்ணுங்க.
Yeah, just basically we are asking to choose from 5 options which will be your first choice of investment for your surpluses. Some of you might think that I could do a combination of 2 or 3. Don't worry about that. I just want you to pick one of the 5 as your first choice. The 5 more questions. If all of you have polled it, the organizer could move to the second question.
Sundaram, responses வருதா?
So let's move on to next question. Hello.
Thank you. The third, so those who have joined in late could also join the poll. The third question is the same question. We are asking for the third choice of your investments. If you're done, we can move on to the fourth, fifth, and sixth, which are easier questions.
Hello.
Session இது முடிஞ்சோம்னா 5 போல முடிஞ்சோம்னா அதோட summary of responses நீங்க எல்லாருக்கும் ஒரு reader பண்ணிங்க.
Yeah, how long you have been in your business? Okay, then we'll move on to the next question. I mean, those who are not in business, you could choose 0 to 5. Yeah, we can move on to the next question. When do you plan to retire? Anytime now or in the next 2 years? Next 5 years, next 10 years, or not just thought about it? If people have answered, we can move on to the last question. How do you manage your wealth? I do it all myself. I sometimes use some intermediaries, brokers, banks. Yeah, I have some private banks managing my wealth. Or the last option, I have engaged a professional advisor for a fee to advise me on wealth management. So with this, the question ends. The organizer will do a summary of the poll results and will be giving to me the next 5 minutes. So we can move on to the session now, if all of you have answered the last question. Yeah, the results have come in for the first question. Most of you have opted for government bonds and bank deposit as the first choice, and the second choice have gone into equity in small, medium, and large caps. And then few have said put it back in your growing business. So these are the three choices which you have chosen for your first choice. As we go along, I'll be giving you the results of the other as well.
Sundaram, on the second idum potrunga. Second results, third appdi varsiya ovana potrunga.
Yeah, this is the second choice. You have stated again government bonds and bank deposits, and then people have chosen small, medium equity caps as well here. And some have said put it back in your growing business as your second choice. And one perhaps have said, or two perhaps have said private equity in unlisted but known company. Okay, thank you. Move on to the third choice. Here again, corporate bonds and debentures is receiving a good number, but here people are saying more about private equity in unlisted but known company. So I kind of now clearly know what's your risk appetite when it comes to making investments. So we will make use of this during our presentation. Sundaram, can you move to the fourth question? So most of you are 0 to 5 years. Nobody more than 20 years. I'm very glad that all of you are first generation, typically first generation, or just budding entrepreneurs. Thank you. The next one. So when do you plan to retire? So many of you have said not thought about it. Some have said next 10 years. So nobody is immediately retiring, which is until next 5 years. None of the attendees, 15 attendees are currently there. None of you are retiring in the next 5 years. Thank you. We'll move on to the next one. Okay, so most of you have said I manage all by myself. Some of you have said I use my certain intermediaries and banks. I think one person has said I've engaged a professional advisor for a fee to advise me. Thank you. Those are the results. Now we'll move on to thank you, Sundaram, for sharing the results, and thank you everyone for participating in the poll. We'll move on to the presentation now. So we are talking to a group of high risk-taking individuals because you are entrepreneurs. You are taking a high risk in running your business. So we are talking to a group of high risk-taking individuals. So when it comes to risk-taking, there are entrepreneurs and there is rest of the world. Clearly, I mean, that's how we view entrepreneurs as high risk-taking individuals. And you're successful entrepreneurs. That's why you are here. You're busy making money. That matters. You have to make money, but it matters more, what do you do with that money? And that's why we are talking about how do you manage your wealth generated out of your own business. So should you reinvest all of the money you earn back into your business? From the responses I see, some of you, or maybe 30–40% of you have said that you will be reinvesting in your business. Here, I'm not prescribing anything here, and there is no one-size-fits-all solution here. But I have something to say. What are the pros and cons in reinvesting in your business? It again depends on the stage of your business, how risky is your business, and how much of the liquidity and cash flow your business needs today from your surpluses. So there are various questions to be answered here. But strategic investing in the initial days is certainly good. But how far, how long, how much, these are dependent on the individual needs. But it's important that you will need to cover yourself if something happens to your business. So what do you fall back on? That's why this wealth management for business entrepreneurs is very different from a typical employer. Because you need that fallback arrangement, you need that risk protection for yourself, assuming something happens to your business. So the last point I'm making here is a very important point, that the investments you make should not be correlating to your business. What I mean by this is, if you are in a technology business, you should not be buying an Infosys stock or a Microsoft stock, so to speak. I mean, it may or may not be exactly relevant or correct in that particular technology business, but I'm saying, just as an overall thumb rule, that you don't invest in businesses which correlate to your own business, because then when something happens to that sector or business, your own business is suffering. In addition, you also have your investment suffering. That's why this correlation is an important concept all of you need to keep in mind while putting your investments. So as entrepreneurs, how do you manage your wealth? Investments which provide robust returns in low growth era. So when do you look for the investments to provide you with more returns, more liquidity, more cash flow, is when your own business is not doing all that well. So that's when I'm talking about the low growth era. So which type of investments would return you a steady return during that era? I think most of you, by choosing that government bonds and bank deposits, you kind of been there. I mean, that's exactly where your risk mitigation lies. I mean, some people might have a different view here, that I mean, it's worthwhile to take a little more risk on your investments, but my view here is very clear. Because you are in a high risk taking business, you should avoid taking high risk in your investment. So that's where I'm bringing this concept of risk appetite versus risk capacity. All of you have the risk appetite because you are entrepreneurs, you are in the business of taking risk, but you have to take into account your capacity to take risk. That is where I strongly recommend that you go in for investments which are more to preserve your wealth, maintain your wealth, rather than hugely adventurous way of investing. So while my question was more small, medium, and large caps in the poll, if you have the appetite to go in for equity investment, you should. I'm not saying no, but choose the large caps. Choose the NSE 100 or BSE 100, for example, in the Indian stock markets, rather than putting it in small caps or medium caps, because that's more volatile. The returns are more volatile. And when something hits the sector, economy, or market, while your own business is suffering, your investments also would suffer. Stick to the large caps, please. I repeat, no one size fits all. The solution has to be customized to the needs of your business, your sector, where to invest. So I'm just giving overall principles here rather than addressing anyone's specific need. So please conserve what you made rather than being on the adventurous side when it comes to investments. Apply very strict risk management in managing wealth. You may not do so as much in running your business because you take more risk, you earn more money. So stick that with your business, with your own business. Don't apply that risk-reward ratio. Take the higher risk to earn a higher reward in managing your wealth. That's my prescription. There's one thing which I want all of you to look at when you look at investment returns. When you compare investment return, please compare post-tax and post-inflation. That's why I used the word EEE, which is a typical tax acronym we use. It means exempt, exempt, exempt. When you put money in an investment, it passes through 3 stages. Stage 1 is when you actually invest the money, and stage 2, when it passes through that investment period, say 5 years or 7 years, for which you have placed the investment. So during this 5 to 7 years, you get a return. So at that time, that return is exempt from tax or not. That's the second stage. Then the third stage is when you actually withdraw that investment on the maturity date. What happens to the tax application, whether it is exempt or not. So these 3 stages: stage 1, investing time; stage 2, during the investment; and stage 3, at the time of withdrawal, whether tax is exempt or taxes payable. There is one example I can give you for this exempt category when you want to invest money, which is a public provident fund. When you put your money in public provident fund, you get exemption. You can deduct some of your income as some ATCC or something of that sort. That particular clause provides you with that exemption of tax to the extent of your investment in the PPF. And then during the 6 or 7 year period or 10-year period, when the PPF runs, you get interest on the public provident fund account, and that is exempt. Again, there are some caps there. You need to go into the details of it, but that's exempt from, you need not have to include that in your taxable income. Then when you withdraw the money at the end of 7, 10, 15 years, the whole principal plus the interest is exempt. There could be exempt tax exempt, there could be exempt tax, there could be, so similar various forms of this. We only talked about PPF, so there could be others. For example, if you talk about an equity investment, when you invest pure equity in a mutual fund or a normal, I'm not talking about the ELSS scheme, I'm talking about a normal equity investment scheme. Just hang on for a minute. I have a feedback that my webcam is not being shared. I'm just trying to see if I could get that back. Thank you. Yeah, thank you. So when you invest in the equity investments, you don't get any exemption, but the dividends you earn out of that investment is exempt, and when you finally sell the stocks, it's exempt again, provided if you sell it after a period of 1 year. So we can go into individual asset classes and see where it applies. My objective of my saying this is to bring to your notice that all your investments, don't just look at the absolute returns as would be advised to you or as would be highlighted to you by the investment managers, because they conveniently forget the tax implication on that return and the inflation implication on the return. Some could be on a higher tax range, some could be on a lower tax range. Some of us who are here in the conference who are non-resident may not have to pay any tax at all. So each one of us have a varied requirements. So we have to look at it from our perspective and see that particular investment, post-tax, post-inflation, what it generates for you, and that is how an investment needs to be compared before getting in whether to invest or not to invest. There's one thing which most of my bankers do. When I ask them, is there tax applicable for this investment? The instant answer most of the banks give, I'm not just singling out one banker, say 4 bankers I have chosen, private bankers, old private sector banks, government sector banks. The immediate answer they give you when you ask them, is tax applicable on this investment? The instant answer they give you is, sir, we don't deduct TDS. So there's 2 different things here. Not deducting TDS and tax not being applicable are 2 different things. If they don't deduct TDS, that's fine. At source, they are not deducting a tax at source, but it doesn't mean tax is not applicable to you. That's a different subject altogether. So they don't answer your question whether tax is applicable on that investment or not. We can give a lot of examples there, but I think the objective is not to go into the individual investment, talk about, this has to bring the whole concept of the implication of tax and how it impacts your return on the investment. I see that nobody is planning to retire in the next 5 years of the attendees today. So some of you have said 10 years and some of you have said we have not thought about it. I have to talk about myself. I'm not an entrepreneur, but I've thought about my retirement, and I possibly fall in the category next 5 years. So I'm perhaps a kind of outlier in this group. But why I think I've thought about retirement, and why I think I think you should at least think about it, not whether retire or not, at least you think about it. Maybe you think your business is your retirement plan. I know, I have a friend who has a passion for books. So his retirement plan is to open a bookshop. I mean, if that's a case with you, obviously you're already in a retirement plan mode, so it doesn't matter. But most of us, I know, are not in that category. We do business for earning money and not for a retirement passion. Are you too busy to think about retirement? Perhaps yes. All of us are busy. We are busy in our business. The business keeps us busy. So we are busy, clearly, to think about our retirement. But I think we should spend some time to think about it. Because why is it important is, the retirement also is linked to the succession planning in your organization. It may be a small company, it may be a small shop, it may be a reasonably medium-sized company. So in each of these cases, you need to have some succession planning. If your offsprings are not interested in running your business because they're not passionate about the same way as you're passionate about your business, if they don't want to run your business, then you need to have some succession planning there. So if your children are not going to take over your business, are there enough managers, are there enough senior guys in your company who want to take it over at a later stage for a payment? So that's exactly what I mean by succession planning here for your business. There was a survey done by Wealth Wala, a book written recently, where the author of the book interviewed about 100 entrepreneurs in India, and the bulk of them were first-generation entrepreneurs. And they thought, the first-generation entrepreneurs thought, the rich typically are busy buying things. They don't need to do anything else, right? But there is an important concept of the wealth management which the rich have to keep doing. And that perhaps was missing in the minds of the first-generation entrepreneurs who got quite a bit of money from their ventures. And that's a startling revelation for me too, in terms of understanding the mindset of the first-generation entrepreneurs. So nowadays, it's no longer a dirty word to accumulate wealth and be a rich person, have some bungalows, villas, and nice cars. Definitely, it's a respectable word to pursue wealth and be a wealthy person. So we are all in the right place. Let's make more money. Remember, your children may not be conditioned to receive large inheritances if you are a first-generation entrepreneur, and you all are first-generation entrepreneur, as I see that you have all been maximum 10 to 20 years in business, so you all are first-generation entrepreneurs. So please prepare your children to receive such large inheritances. How do they manage it? How do they not get spoiled with that kind of riches? I mean, these are some things which are linked to retirement. That's why I'm bringing that in this slide. Okay, giving in two ways. One, giving to your children, giving to your offspring, giving to your next generation of what you earned, that you could give through a proper estate planning, which we will be covering in the next slide in a little more details. Giving also has another meaning, giving in terms of charity. So you might be wanting to think about that as well. Now, my grandfather, in the 60s and 70s, he accumulated shares in Colgate and McDowell in thousands. I mean, nobody in those days bought shares in the market, but he had the vision to do that. And it's not just that those shares got rich in value. From say 10 rupees, it went up to 2000, whatever it is. But there are several other things which doesn't come out in a graph, right? Over the period of last 30, 40 years, each of these companies have given a lot of rights issue, a lot of bonus issues, a lot of dividends. And the cumulative wealth accumulation on these type of a few investments which my grandfather made is unbelievable. I mean, we are some 15 grandsons and grandchildren, and we still have got some money out of those investments. That's a kind of wealth amassment which could happen in certain investment. That's a point I wanted to make here. There's another question we asked in the poll about how do you manage your wealth? I manage it all by myself is what most of you said, and some of you said I use certain intermediaries like banks and brokers. I think one or two said I engage a professional advisor for a fee to advise me on wealth management. I did ask this question because we all believe in value for money investments, value for money decisions. We all of us are known for it. The Chettiar community is known for the value for money attitude, like the Marwadis. We are known to be for the value for money. So my point here is, yes, if you hire a professional advisor, there is value for money. Where is the value coming? Because the advisor would typically charge you a fee, right? So you're paying a fee. Why should I pay a fee? Is the first question come to most of your minds. But I still believe there is value for money if you hire a professional advisor rather than you doing investments through your banks or your brokers or something. I'll tell you what. There is no conflict. He is working for you. He's not working for the bank. Your advisor, you pay him 0.1%, 0.2%, I don't know, whatever be that number be, he is working for you. He's not working for the company which wants to sell you the investment. So he is able to give you a very professional advice without any biases as to which one to pick up for your own benefit to create more wealth. I hope you all remember the rating agency, the global rating agencies, Moody's, Standard & Poor and Fitch, all three of them, in the time of global financial crisis in 2008 and 9, they had rated all these prime, subprime securities as AAA. AAA is considered the safest possible investment in the world. I mean, nothing can go wrong. You can just put your money blindly. Close your eyes, put your money blindly. Nothing will happen to those AAA investments. But what happened to those AAA investments, those subprime investments? It all went to default within a period of 1 year. Once that subprime crisis was known and people knew what was happening and what went wrong in the subprime securities, all those AAA securities within a period of 6 to 12 months, they all went into default category. From AAA to default is a steep fall. So what went wrong? The rating agencies, you are the investor, you are buying the investment. You are not hiring the rating agency. You are not paying the fees of the rating agency. The rating agency fees are paid by the banks who are selling the product to you. And that is clearly the problem in terms of the rating agency tending to believe, because their paymasters are the banks, tending to believe what the bank says is correct. It cannot be all that wrong. So AAA is AAA, and they gave a AAA rating to all those securities. What happened? They were not AAA. They were not as secure as what they thought or what they have been told to be believed. That's why I say hire an advisor, pay a fee, you will get value for that. And nobody today can guarantee investment performance. I'm not saying a professional advisor, if you pay him a 0.1% or a 0.2% fee, he will come and guarantee an investment performance. He will say, okay, be rest assured, I'll give you 12% return for the next 5 years. No one can say that. No one can guarantee that. Unless you put in a bank deposit, a HDFC bank, a safest bank or State Bank of India, put it in a fixed deposit, you will get 7.5%. That's safe. That's almost guaranteed, right? Because it's as good as a government risk. But beyond that, nobody can guarantee investment performance. Even a professional advisor cannot. It's a dynamic market environment. So the decisions you took today may not be right 3 months down the line, may not be right again 6 months down the line. So it's a dynamic environment. You need to keep changing your decisions. You need to keep changing your portfolio. You need to keep relooking at and then rebalancing your portfolio. If you don't have the time to do that all the time, right? That's why a professional advisor comes in handy here. You paid him a fee. So he will be taking care of that need and obviously telling you that your portfolio looks like this in the current market environment. This may not be the right portfolio mix. Why don't you make a change here? Why don't you do something here? That's the kind of advice you expect from a professional advisor, and that's what you will get. Now, in the US, there is also robo-professional advisors. You know, there is computer systems which are engaged. There is, instead of human being, there's robo-advisors sitting there, and they are low cost, obviously, because they're efficient, and they advise you as to what is to be done. There is no, what do I say? There is no emotions here. They don't understand your personal needs, but it works because it's a low-cost solution to a lot of investors who basically need somebody to really look at the portfolio on a periodical basis and give some advice. But obviously, then you are the best judge based on that advice, based on that professional feedback from a robo-advisor you can do. But if you ask me, I would not prefer a robo-advisor. I would prefer a human advisor. But what I'm saying is it's available for you in the market today at a low cost. Now, I put something called National Pension Scheme, which has been there in work for some time now, but not. I don't think any one of us are fully aware of what this scheme is, what benefits it can give you, why I'm talking about this. I'm not sure if anyone has invested in this scheme. If you have invested, you can pat yourself, because this is a Government of India scheme which believes in a low cost efficiency, low cost operation. So they don't engage sales guys who will go and sell the schemes and who will charge a 1% as a sales commission. They typically put their money in a kind of exchange traded funds, ETFs, which are again low cost. So they operate on a low cost business model. So with the result, your cost in terms of having to pay the wealth manager, the asset manager there is very limited. So if you're getting a gross return of 10%, you typically pay 2.5% in a normal mutual fund. Here you will pay something less than 1%. So the net return post expenses is pretty high in national pension scheme. Why we are not aware that such a scheme exists, or why we are not very familiar with this? Because no sales guys want to sell this, because he's not getting a huge commission out of this. Rather, he would sell you a unit-linked insurance program, because that gives him a sizable, solid income. So you will always find the sales guys, not the professional advisor, the sales guys, investment sales guys will come and tell you, why don't you buy a unit-linked insurance plan? That will be their first product they will be selling you. Why? Because they think that's good for you? No, because that is what will get them the maximum sales commission in the year one. They will all sell you the same product, whether you need it, you don't need it, whether your business, your current risk situation requires a policy, insurance policy, whether you need that kind, you need to pay that kind of commissions to pay. Irrespective of all of these stuff, they would keep coming back to you and selling unit-linked insurance plans. They will never talk about national pension scheme. That will be in their list of their priorities. But ideally, if you want an insurance, you should go typically for a pure term insurance. You pay a fee, you pay a premium, forget about it. The premium need not be invested anyway, that's an expense. Pay that and move on in life. Even that pure term insurance, not many sales guys would do, a professional advisor will do. That's the reason I'm saying a professional advisor gives you value for money. Look for the right professional advisor and you will benefit out of that. Don't go with the sales guys for investment. They will always sell what suits them rather than what suits you. Small fee, you can even agree on a smaller fee and then share profit on performance. That incentivizes them to keep looking at your portfolio, advising you the right way, so that you share some profits with them. If it goes, say for example, if I'm able to earn more than 10% per annum, anything I earn more than 10%, I share 20% with you. So you are clearly incentivizing the professional advisor to do more for you, to spending more time on your portfolio, to be more proactive, calling you all the time. Give them a small fee, but give them more on profit performance. So now we come to the estate planning. I talked about this is an important component of the wealth management exercise. What do you do in wealth management? Please write a will. We had talked about it in some other forums, but on this forum, I would strongly recommend that whether you're rich or poor, whether you're old or young, one must write a will. One must write a will. It's very, 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 very important to avoid conflicts, to avoid any kind of issues later on in terms of delays in settlement, delays in distribution of your wealth to the right people you want the wealth to go. Please write a will. That's part of your wealth management exercise. Sometimes we talk about holding companies, trust, and some may believe this is for real high, ultra high net worth individuals who have investments across the globe, who have investments across asset classes. Not necessarily. I'll give you one example. If you have a real estate investment in Dubai, it actually makes sense to have a holding company holding that real estate rather than an individual holding that real estate. I'll tell you why it helps or how it helps. You create a company, say in a BVI, British Virgin Islands, or in a Jersey, and that company shares you own. 100% of the company shares you own. And that company in turn owns the real estate in Dubai. Now, what happens in the event of anything happens to yourself? God forbid, then a jurisdiction like Jersey clearly understands a will, clearly understands the estate planning. So if you have a will passing on that benefit in the house, 50% to your daughter and 50% to your son, then straight away that shares are split into two. 50% of the shares goes into son, 50% of the shares goes into the daughter without anything happening in Dubai. The ultimate beneficial ownership of that company has already moved in the way you wanted it to move by creating that company. So not necessarily complex, not necessarily to be used by ultra high net worth. You can use it if you think it's appropriate for your need. Just on the real estate, I needed to say one thing again to go back. Real estate in Dubai, I think there are some people from Dubai out of this in this conference. Real estate in Dubai, should one invest or not invest from your overall perspective? I would recommend maybe one property in real estate in Dubai. It's worthwhile, but nothing more than that, because your own prospects, your salary, your increments, your bonuses, your promotion, your job safety, everything depends on the UAE economy's prospects in general and Dubai economy's prospect in particular. So when your income stream is dependent on a particular economic growth, you don't want your investment growth also to be based on the same economic growth. That's where I'm saying there's a correlation here. Avoid those correlation. That's my advice. So you could buy something in Singapore, and the guys listening from Singapore or India or Australia here could buy in Dubai. There's no problem. Dubai is, in my view, a good place to invest. It gives you rental yields of 5 to 7%, a net rental yield of 5 to 7%. Of course, you have to take a call on how the property prices will go up. That you need to take a call. But clearly, nowhere in the world you get a rental yield of 5 to 7% in dollar terms, right? Dirham is UAE dirham is a peg currency. So in dollar terms, you get 5 to 7% net rental yield on properties in Dubai. Okay, succession planning at your business. You're offering, we talked about this, may not be as passionate as you in the business. The biggest risk that you may be is that if you don't do the succession planning, is that you may not be able to get the value you want to get out of your business. Say a Paytm could sell at $500 million, a taxi for sure could sell at $10 million, but not all business get the same value as that, right? So that's why it's important you have the proper succession planning in your own business. So we are through with the presentation. I'll quickly summarize and then move on to the next presentation. Time to think on correlation of your investment returns versus business returns. Plan for your retirement. If you have not considered before, please consider now. Write a will, very important. And do other all estate planning measures, what we discussed during the presentation. Look at your investment return post-tax, post-inflation. Hire a professional for advice. Thank you. And
so at this point, before moving to the next topic, any questions, you can pose these questions. Sundaram, can you unmute all the participants, please?
Unmuted.
Thank you, Sriram. Can you mute all the attendees? Thank you, Sundaram. We'll move on to the next presentation, which is the credit insurance for de-risking trade. It's what do I say? It's unique and relatively new for most of us. We may not be using this product on a regular basis. So the idea is to provide you with some awareness and some introduction to the product rather than deep diving into actual execution of the product. So the idea is to create an awareness for such an important product and why is it so important. If you look at this, this clearly explains to you what a credit insurance does for you. You have on the left bottom the insurer. In this case, it's the Euler Hermes. It's an international insurance company. So they provide insurance to companies like yourself who are selling goods. So you are the seller, you are on top, you are the insured, you buy the insurance from Euler Hermes, and you sell goods to the buyer against a trade credit of 90 days. Then you cover it with a credit insurance from a company like Euler Insurance. And what Euler Hermes does is they monitor the risk and they also collect the debt on your behalf from the debtor. So in the process, what happens is in the event, if there is a problem in collecting the debt from the ultimate buyer, you stand protected as the insured, you stand protected and the losses are absorbed by Euler Hermes. So this is broadly what the credit insurance is all about when it comes to short-term trade. So there are two things I want you to keep in mind. Some audience are there from India as well. So right now, this slide talks about international availability of trade insurance. In the next slide, we'll be talking about the Indian availability of trade insurance. So the international obviously is available to most parts of the world. Firstly, remember, we are talking here about short-term credit insurance, that is up till 12 months, more for working capital trade-related areas, and not CapEx areas. CapEx areas are covered by a completely different insurance. So we are not talking about those ECAs, which is the Export Credit Agency related insurance. We are talking purely about short-term trade credit insurance. It's available both for domestic sales as well as available for export sales. The two type of policies are available from the insurance companies for sellers like yourself. One is a whole turnover policy, which is you go buy a whole turnover policy covering your entire sales turnover, which means you cover your entire risk sales, that buyer's default risk with the insurance company. Or you could alternatively go and ask for specific buyers, specific markets. Both have some differences. Obviously, you will have a lower premium when you go for a whole turnover policy. You will have a higher premium when you go for specific buyers. The cover available is anywhere between 70% to 95%, depending on the riskiness of the trade, riskiness of the buyer. Various levels of cover is available in the international markets. So what I mean by 70% cover is if the debt go bad, 70% of the debt will be insured by the insurance company. That means you bear a risk of 30% of that sales. And if it is a 95% cover, which is rarely and selectively available, you bear 5% of that risk. It covers political risk for exports. So what do I mean by the political risk? When you export, you're exporting into a third country. So the third country may have some issues relating to the country-related issues, a political risk. Say their currency could be devalued, their currency cannot be expatriated. They may pay in the local currency, but they are unable to send foreign exchange because there is not enough foreign exchange available in that country. This is what we call the externalization problem. So for example, today as we speak, this exists in Nigeria in a big way and in a small way, Egypt. So in these countries, you can export. They will give you the money in the local currency, but it will be difficult for you to get the money in foreign currency. So this particular policy covers the political risk, including the currency exchange risk. And suppose something happens to the country itself, right? The president goes away, new president comes, everything comes to a standstill. So those type of political risks are covered for your exports, which is an important risk to cover because you can't take a call on your sales to those countries. And it covers the default risk. When I say the default risk, the payment risk. So this is purely a commercial risk. So political risk and the commercial risk both are covered by these policies. For domestic trade, you don't need the political risk. You only need the commercial default risk. And the first loss payee for such policy could be banks like ourselves. So we get the benefit when we are the first loss payee, we get the benefit, we get the comfort. And then what we will do is such trade where you have taken a policy and where we as bankers are the first loss payee, we will be happy to discount those receivables and give you money. So you get financing, you get cash flows, and you get at a cheaper rate. Normally, without the insurance policy, you won't be getting it at that kind of low rates of interest. With the insurance policy, we will be reducing the rate at which we'll be lending money against those receivables. So these insurers, the international insurers we are talking about, who are they? I have in the later slide, I've mentioned a few of them. They are well-rated insurers worldwide, well-rated as a AA type rated insurance. So there is no counterparty risk for you. Once you have bought an insurance policy, you can have a peaceful night's sleep. You don't need to have a sleepless night, or what will happen if they don't pay. So this is the risk mitigation which insurance policy provide you on credit insurance. So what are the key features? It's protection against, we talked about the commercial risk, right? The insolvency of buyers. That means your buyer could go completely insolvent. He doesn't have anything to pay. And not just that, even a protracted default. The payment is due on 90 days. He doesn't pay until 120 days. So that's considered as a protracted default. So you are protected even against that. You don't really need to take him to a court of law. The court should consider him insolvent before you can take your policy proceeds. You don't need to wait for the entire court proceeds to get over. If there's a default, you just declare a default and then inform the insurance agency, you will get protection against it. And we talked about the political risk for the exports, where you are covered for the sovereign country and exchange risk. It helps you to expand sales to existing clients, because you might be under the impression that these existing clients may not really like to buy more because I can't take more risk on them. So this policy helps you to do more with the same customers. And it also definitely helps you to get into new customers and new markets. It optimizes bank financing, as we spoke in the last slide, that banks will be very keen to lend against such policies because it gets protection against from a A-rated or AA-rated insurance agency. And it strengthens your risk management. So what do I mean by that is, when you buy such policies, these insurance companies also be giving you and sharing with you information on the past track record of these buyers, whether they delay, they don't delay, do they pay on promptly or not. Those type of information comes to you. So you tend to pick up some good risk management strategies from these large insurance companies. So that way it helps by getting into policies. You get into a professional set of guidelines and procedures within your own organization, because you need to report to them, you need to give them MIS. So you strengthen your own risk management when it comes to the trade insurance. Remember, it's only for short-term account receivable up to 12 months. Anything beyond 12 months are not covered under such credit insurance for trade. So you all would be keen to know what the cost of such insurance, because we're giving so much protection, gives you so much benefits. What is it? The premium is actually based on the actuarial techniques. An insurance company looks at the riskiness of the product. How risky are those buyers? Are they too many in number, lesser in number? Is there a concentration risk or no? There are only 2 or 3 buyers who contribute to 80% of your sales. So these are the type of thing they will be looking at. So it's very difficult for us to say what will be. The whole turnover will cost you less than a single policy. It's charged as a percentage of your annual turnover. It depends on the type of buyers, type of countries you sell, and type of commodity you sell. It ranges between 0.2 to 0.5, I would say, of your turnover, percentage of your turnover. Definitely, some of you would consider this very expensive because you are in the business of risk taking. You can hedge those risks, but the moment you hedge those risks, you are giving away some cream to the insurance company. You are giving away some of your profit to the insurance company. So you need to decide whether it's worth paying that cost to buy that insurance, worth paying that cost to buy that sleepless nights, peaceful night sleep. So this is something you need to take a call based on your own business, your own nature of your buyers, how risky are they, you want to do more with them or not, etc., etc. Now we come to the Indian regulation, which is very different from the global insurance market. In India, actually, this product is not pretty prevalent and popular because of some of the regulations which the insurance regulator, IRDAI, has come up with as late as April 2016. There's a background to this. In India, there are some issues which came up. People were misusing this insurance policy to take financing, especially in the sectors, bullion and diamond sectors. People are misusing this facility. That's why the Indian regulator has to come very hard on providing such domestic credit insurance. In India, still for exports, you get decent good policies from organizations like ECGC, Export Credit Guarantee Corporation of India, and Exim Bank. So you do get for exports decent policies. On domestic, there is an issue. The regulator is died, and the guidelines were revisited in March 2016. They have put a cap of only 85% available for people, not more than that. You can only get whole turnover policy. You cannot buy single client cover. They have given some relaxation here. If a particular medium-sized company doesn't want to cover their entire turnover, they could just say one segment within that turnover. Say, for example, if they are into 3 products, they can cover only one product, but all buyers in that one product, or all buyers in one country, something similar to that. So they are the insurance market is very regulated when it comes to credit insurance in India. And if a particular buyer constitutes more than 2% of your turnover, then the insurance company has to do a full-blown credit assessment. It's mandated. Otherwise, they can't give you the policy. And it cannot be issued in favor of banks, FIs, because of some past issuance. They have made these regulations new now. So now you know why there are some restrictions. I mean, people will have to come up with some novel idea, and in terms of moving this product pretty much into the Indian markets. It's there, but it's not very popular at this stage. These are the major global players. Atradius, Coface is a French firm owned by, it used to be owned by the government of France, now it's owned by Netaxis, a private French bank. Euler Hermes, it's a German firm. AIG is American Insurance Group. In India, their partner is Tata. They provide credit insurance in India through the Tata Group. AIG provide. Then there's Lloyd's Syndicate, which is actually a market rather than a player. Lloyd's Syndicate is a market, and if Lloyd's Syndicate provides you with a policy that's well rated, one should go for it. Then you have ECGC in India, which provides policies for your exports out of India. So in summary, remember it's short term. I talked about risk capital versus growth capital. So you want to run with the risk, you run with the risk capital, don't go for the insurance. You want to protect your capital, you want to protect your risk, then you buy the insurance and move your risk capital into growth capital. So the choice is yours. You want to take the risk or you don't want to take the risk, depending on your own risk needs within your own business. Whole turnover, we talked about. There are also single policies available. Exports, domestic, for both credit insurance is available. It covers 2 risks, political risk and commercial risk. It provides you better profitability at lower risk. Sounds good, but it depends on as I said, it depends on your individual client, company need as to how risky is your business and how risky is your receivables. Gives you enhanced cash flows, higher sales, and better customer relationships. And thank you very much. And now we can open this for any questions, we can again unmute Sundaram. Yeah, if anyone has questions.
Questions or feedback, please do share some.
ഉണ്ടായിരുന്നല്ലോ റോസിന്റെ ഇമെയിൽ ഉണ്ടായിരുന്നല്ലോ സജഷൻ
ஆகாது நார்மலா சொல்லு இது உடனே இரிட்டேட் ஆகாத
2 3 bedroom town without retail 59 നടക്കില്ല വിളിച്ചു പറയണം റോസ് ഇൻഫോം ചെയ്യാതെ അവർ അലോ ചെയ്യില്ല
Voice clarity is not there, so we could unmute and then we can ask people to share. Yeah, request is if you can go into the chat mode and ask your questions, because the voice quality coming from all across the attendees is not good. If you have any questions, request you to send through the chat mode. You could see that there is a chat there. If you would click the chat and then type out your question, I'll be able to see that, and then I'll be able to answer you on the voice mode.
To all the people, thank you for attending the webinar. Anna Romba, thanks for taking your time out in terms of researching on both these topics and giving a structured presentation. To all the attendees, we will send the presentation. In case of you have any queries or clarification, email Mulyamavo through WhatsApp or through anybody, you can send these questions. We'll try to get them answered. Thank you all for your time and attending this thing. If feedback irundhalum, please do share the feedback. Hello. If feedback irundhalum, please do share the feedback with us. It will be very helpful for bringing on more topics and sessions for you as part of the IBCN 2017 initiative. Thank you all for today morning. Thank you.
Thank you. Thank you very much. Thank you all. Bye-bye. Have a good day.
Now we can look at the statistics over there.